These investing facts are flat out wrong in 2026. 1. You should cash out when you've made enough profit. Define enough. This is the mentality that keeps people from generational wealth. You bought Amazon at $100. It hits $150. You sell and take your 50% profit. Congratulations, you just missed the run to $3,000. People treat investing like it has a finish line. I made 30%, time to cash out. Why? If you believe the company is still strong and growing, why would you sell? Because it feels like you've won? Taxes are a real thing. Every time you sell, you trigger capital gains taxes. If you're constantly cashing out, you're constantly paying taxes and restarting your compound growth. The wealthiest investors hold for decades. They let winners run. They don't sell just because they're up enough. They sell when the fundamentals change or they need the money. Taking profits sounds smart, but it's often just impatience disguised as strategy. If you're investing for long-term wealth, there's no such thing as enough profit until you actually need the money. The stock market is just gambling. If you think investing is gambling, you don't understand either activity. Gambling is a zero-sum game with odds stacked against you. The house always wins. Investing is buying ownership in productive businesses that generate real profits and grow over time. Over the last 100 years, the stock market has returned about 10% annually. Casinos don't have a 100-year track record of making their customers wealthy. Yes, short-term stock movements are unpredictable. Day trading is basically gambling, but buying an S&P 500 index fund and holding it for 30 years? That's not gambling, that's math. Companies produce goods, generate revenue, create profit, and share that profit with shareholders. That's not chance, that's capitalism. The people calling it gambling are usually the ones who bought GameStop at $400 because Reddit told them to, then lost everything and blamed the rigged system. That's not investing, that's stupidity with a brokerage account. Real estate is always a good investment. Tell that to everyone who bought in 2006 right before the housing market collapsed 50%. Real estate can be a great investment, but always is doing some seriously heavy lifting in that sentence. Real estate comes with property taxes, maintenance costs, insurance, HOA fees, and the risk that your neighborhood turns into a crime-ridden disaster zone. It's illiquid. You can't sell half your house on a Tuesday if you need cash. It's leveraged, meaning most people borrow money to buy it, which magnifies both gains and losses. And it's location-dependent. A house in San Francisco appreciated 400% over 20 years. A house in Detroit lost 60% of its value. Real estate always goes up is what people said in 2007, right before millions lost their homes. It can be a good investment if you buy smart, in the right location, at the right price, and can afford to hold long-term. But it's not a guaranteed win, and it's definitely not passive income when the water heater explodes at midnight. You should sell when the market crashes. This is how you permanently lose money. Markets crash. It's not a question of if, it's when. The S&P 500 has had dozens of corrections and bear markets over the last century. Every single time it recovered and went higher. Every time. If you sell during a crash, you lock in your losses and miss the recovery. In March 2020, the market dropped 34% in a month. People who panic sold locked in devastating losses. The market recovered by August and ended the year up. People who held made money. People who sold stayed broke and developed trust issues. The correct move during a crash is to do nothing, or if you have cash, buy more while everything's on sale. Selling during a crash is like burning your house down because the market value dropped. The house still works, the stocks still represent ownership in real companies. The price is temporary. Panic is expensive. Dividends mean a stock is safe. Dividends are nice, but they don't mean a company is safe or a good investment. Plenty of companies pay dividends right up until they collapse. General Electric was a dividend aristocrat for decades. Then it cut its dividend by 92% and the stock cratered. Dividends come from company profits, and if those profits disappear, so do the dividends. Some companies pay high dividends specifically because their stock price is tanking and they're trying to attract investors. It's a trap. A 10% dividend yield sounds amazing until you realize the stock is down 40% and about to cut the dividend entirely. Dividends are great when they come from stable, profitable companies with long histories of paying them, but they're not a safety guarantee. They're a feature, not a quality signal. You need to evaluate the whole company, not just chase the highest yield and hope for the best. You should wait for the market to drop before investing. This is the myth that's cost more people more money than almost any other. Sounds logical, right? Why buy now when you could buy cheaper later? Here's why. You have no idea when later is. The market might drop 10% next month, or it might go up 30% over the next 2 years, and you'll have missed all those gains waiting for a dip that never came. Time in the market beats timing the market, and the data proves it. If you invested $10,000 in the S&P 500 in 1980 and just left it, you'd have over $1 million today. If you tried to time the market and missed just the 10 best days over those 40-plus years, you'd have less than half that. The best days often happen right after the worst days, so when you're sitting on the sidelines waiting, you miss the recovery. Dollar-cost averaging, investing consistently regardless of price, beats trying to time entries every single time. Investing is only for old people thinking about retirement. This might be the dumbest myth on the list, and it's everywhere. Young people hear investing and think it's something boring their parents do for retirement in 40 years. Meanwhile, they're spending $200 a month on bottle service and wondering why they're broke. Investing isn't about being old, it's about using time and compound interest to build wealth. A 22-year-old investing $200 a month until 65 ends up with over $1.4 million at 8% returns. A 40-year-old doing the exact same thing ends up with $300,000. The 18-year head start is worth over $1 million. That's not about retirement, that's about math. The younger you start, the less you have to contribute, because time does the heavy lifting. Thinking investing is only for old people is like thinking exercise is only for people who are already fit. It's backwards. The people who need it most are the ones ignoring it. You need to be smart or know about finance to invest. Absolutely not. Some of the wealthiest investors are people who bought index funds and did nothing for 40 years. Warren Buffett, literally one of the greatest investors ever, recommends that normal people just buy an S&P 500 index fund and ignore everything else. You don't need to read financial statements, you don't need to understand price-to-earnings ratios, you don't need a finance degree. You need to understand one concept. Buy diversified index funds regularly and don't sell when the market crashes. That's it. The people who think they're too dumb to invest are often smarter than the people who think they're geniuses because they picked 3 stocks based on Reddit posts. Simplicity beats complexity in investing. The Harvard MBAs running hedge funds get beaten by index funds 90% of the time. You don't need to be smart, you need to be disciplined and patient, which are completely different skills. You need a lot of money to start investing. False. Completely false. This myth keeps broke people broke and benefits nobody except the financial industry that wants you to feel like investing is for rich people only. You can open a Roblox account with $1, literally $1. Fidelity, Schwab, Vanguard, they all have 0 account minimums now. You can buy fractional shares of Amazon for $10. You don't need $3,000 to buy 1 full share. The "you need money to make money" line is what poor people tell themselves to avoid feeling bad about not starting. Meanwhile, someone investing $50 a month from age 22 ends up with more wealth than someone investing $500 a month starting at 40. The best time to start was 10 years ago. The second best time is today with whatever you have, even if it's $25. Investing in individual stocks is better than index funds. The data says you're wrong. Over 90% of actively managed funds run by professionals with research teams fail to beat the S&P 500 over 15-year periods. If professionals can't beat the index, what makes you think you can? Picking individual stocks means you're betting you're smarter than the market. Maybe you are. Probably you're not. Even if you pick a winner, you need to pick enough winners to outweigh your losers, cover your trading fees, and beat the index return. It's possible, but unlikely. Index funds give you instant diversification across hundreds of companies, low fees, and average market returns, which historically is about 10% annually. That's enough to build serious wealth without trying to be a stock-picking genius. The people getting rich off individual stocks are either incredibly skilled, incredibly lucky, or lying about their returns. For everyone else, index funds win.